Good day, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and watching the Market Chameleon webinar series, where today we'll be talking about tracking implied volatility, smile by strike. But before we get started, let's take a look at the shared disclaimer. Please be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This webinar, as all our webinar shows, are for informational purposes only concerning Market Chameleon tools and products. One last look at the disclaimer before we welcome Dimitri Pargamonic to the stage to talk about tracking implied volatility, smile by strike. Welcome, D.
Good morning, Will. How are you?
How are you doing today, my friend?
Good. Share my screen here.
Yep.
And let's go to, before we start, I'm going to go set it up to show our examples. So let's type in Google in the search box. This will take us to Google's main home page. And what we want to do is take a look at how did the implied volatility change in a particular month, but get a sense of the shift in the smile. Okay, because when we look at implied volatility, there are different options with different strikes, different months. So the implied volatilities on these options could change. And what we want to do is take a kind of figure out how did that implied volatility change across the smile. So one way we could do is look at under this options menu, we click on options and let's go to the single leg dashboard. And I'm going to click on this menu to minimize and expand our screen. And this takes us to Google's analysis page where we're looking at single leg trades. But below, if we slide down, we have this table. And in this table, we have a list of the options expirations. You could tab them like this or expand them. Let's just expand them. And for each expiration, we have these corresponding analytics, statistics, and data. Usually when we look at the implied volatility, we'll reference the at-the-money IV. So the at-the-money IV is over here. You could see these are the at-the-money implied volatilities for each of these expirations. And what that does is it looks at where the current stock price is, then looks at the surrounding at-the-money strikes, calculates the implied volatility based on weighted average formula, and comes up with this at-the-money IV. And that's one way to track at-the-money implied volatility change, even within an expiration, because we can look at the at-the-money IV currently and compare it to, let's say, yesterday's closing value and see the change. So if the at-the-money IV yesterday was 25, today it's 26, then it's up one click, just like you do a stock price. However, when we look at it that way, the stock price could move and we get this new at-the-money strike, right? So when we look at, let's say Google, it was up $19 yesterday, right? So up 9%. So today's at-the-money IV would be around 231, right? 231.10. But yesterday's at-the-money IV was $19 lower. So even though we're comparing an implied volatility at the money, the strikes that we are looking at are different, right? So that is one way to measure it. But another way to measure implied volatility is comparing the strike versus strike. Well, we could see what the 231 strike is currently and we could compare that to the implied volatility of the 231 strike yesterday to see how the 231 strike IV changed. So that's another way to compare it when you're doing it strike per strike. Okay, this happened to be a very big, large move yesterday because there was news. But sometimes, you get smaller moves and you want to compare, well, how did that strike change? So that's what this is coming. So I'm going to come back down here. And you could see here that this implied volatility is looking at the monies, currently at the monies, and it's comparing it to yesterday's implied volatility on the same strike and calculating the change. Okay, so with right now, it's saying the at the money implied volatility, let's say 231 is 30, and then it's comparing it, well, what was the 231 strike yesterday and what's the change in? Okay, so this is looking at strike versus strike. Okay, by strike, previous close. So now we get to see kind of what the implied volatility actually changed on that same strike, which could be different because sometimes a stock can move to a different strike and the implied volatility didn't really change on that strike. But if we compare it to previous day, it could look like a change just because the stock moved to a different strike that had a different implied volatility. Okay, I'll show an example. Let's go to the option chain. And here in the options chain, we have all these different strikes, right, in Google, September 19th. But you could see that these different strikes have different implied vols, right? These are the implied volatilities of the bid, implied volatilities that they ask. So let's say the stock today, if it moves from 230, right? Let's say from 230, let's say the implied volatility is 27. So right now that the money vol is 27. But let's say it moves down to 220, right, today. Well, if it moves down to 220 and the implied volatilities on these strikes stay the same, that means 220, this implied volatility would be 28.1. Well, if we compare it to the 27.1, it looks like it went up one click. So it looks like implied volatility at the money implied vol went up one click, when in actuality, this 220 just stayed at 28.1 and the stock moved to it, right? So now the stock moved to it. That's the new at the money strike. So really, implied vol didn't change. It just the stock moved to that new strike, and the implied volatility stayed the same. Okay, so that's what this is when we look at this single leg dashboard over here. This is looking at the change in the strike price. It's looking at the same strike from the previous day and looking, did it actually change? Did the implied volatility on that strike actually change? This gives us a little bit of a different perspective, because this is saying, yes, it did. The implied volatilities actually went down on that same strike. And does the same thing with an out of the money put and out of the money call. So this lets us also kind of get a metric of, now we see the strike, that the new at the money strike did go down. What happened to the out of the monies? How does that, did the smile look like it also shifted down on the 25 delta put or 25 delta call? So again, this looks at the 25 delta put, finds that strike, and compares it to the previous day to see if that implied volatility went up or down. And here, knowing that, we could kind of then see, okay, just looking September 5th expiration, September 12th, September 19th, that the curve shifted lower kind of across the board. The at the money and the 25 delta put and 25 delta call all shifted lower. Here it shows that the upside was down by bigger percentage than the downside put. So even though they all went down, it looks like those upsides, right, the 25 delta call took a bigger hit or bigger decline in implied volatilities than the downside puts. Okay, so Will, I'm going to stop there and throw it back to you, but I wanted to, demonstrate to people how they could quickly kind of get a view or a sense of what happened to the implied vols within that expiration.
Yeah, that was great looking at tracking implied volatility by the strike, D. That was awesome. Thanks for bringing these webinars to the Chameleon community. We have one more left this week. We're going to be here tomorrow on Friday. Great job, my friend.
Thanks, everyone, for joining. Stay safe out there. Hope you guys have a great trading day.
We'll see you tomorrow, D. Bye. Hey, everyone. Thanks for joining the Market Chameleon webinar series. If you're on any of the social platforms watching this, please like and follow. If you're on YouTube, thumbs up, always appreciated. Everyone have a safe trading day out there, and we will see you tomorrow. Have a great day.